Good evening, class. You're welcome to another class with us here at Equity. Today, we will be moving forward. So last week, we looked at IS 36 on impairment of assets. And in looking at that, I made some very important points. The very first of which was the objective of IS 36. I told you that the objective is to ensure that an entity does not account or recognize its assets in its book above its recoverable amount. So we want to ensure that the carrying amount of an asset is not higher than its recoverable amount. And we said that if for whatever reason that should happen, we are going to describe that asset as impaired. And I immediately made you know that these assets we are considering in IAS 36 are basically your tangible and intangible assets. Your tangible assets, like your non-current assets like PPE and investment properties and what have you, and your intangible asset as the case may be. You see, what IAS 36 is out there to achieve is that ensure that your carrying amount reflects its realistic value. And realistic value, which is the recoverable amount of that asset. And we explain further that recoverable amount is the higher between the fair value less cost to sell and the value in use of an asset, which goes to show that the recoverable amount mainly reflects the higher between how much you can recover from selling an asset or from continue to use an asset. The maximum of those two, is what we believe is the realistic value or the recoverable amount of an asset. And we believe that we as accountants, when we are preparing or accounting for our assets, our book value or our carrying amount should not be higher than that. It should not. If for whatever reason is now higher, that asset is said to be impaired. You need to impair it immediately. And the way you even know that an asset is being impaired, I told you that the very first of which is that we need to identify indicators of impairment. And speaking about indicators of impairment, we said there are external indicators and internal indicators. The external indicators, which are usually above the control of the entity, include items like where there is a fall in the market value of the assets, which is usually beyond what can be attributed to passage of time, or where the entity's net assets is higher than the entity's market capitalization, or where there is an increase in interest rates that is used to calculate and the entity's asset that is used to calculate the value in use of the entity's asset, or when there is a change in technology, there's a change in market and economic environment in which the asset is located. These are external indicators of impairment. The internal indicators are where there is an evidence of obsolescence of the asset or physical damage, or where we have a situation where there is a decline in the lifespan of the assets, or where there is an adverse change in the use or in the economic performance of that asset. All of these are internal indicators of impairment. And we say that when we see any of these indicators, in fact, looking out for these indicators, I told you, what you're doing invariably is impairment review. And when you do this impairment review, by looking at these indicators, if for whatever reason you confirm that any of these exists, then you need to move to the next stage or the next level, which is to test the asset for impairment or impairment test. An impairment test majorly is just determining the recoverable amount of the asset. That is impairment tests, determining the recoverable amount of an asset. Of course, when you then determine the recoverable amount, then you would obviously know whether the asset has been impaired or not. However, when there are certain assets that whether these indicators are present or not, you don't even have to look for indicators. The standard requires that you would have to test them for impairment annually, with or without indicators. And there are two of them. I told you we have goodwill that is acquired in a business combination. And the second one is an intangible asset with an indefinite useful life. These two assets are usually tested for impairment annually. You don't need to look out for indicators. Now, when you test an asset for impairment and you have an impairment loss, this impairment loss will be debited to P&L and a corresponding credit will go to the asset account. However, if there is a previous evaluation surplus on the same asset, again, if there is a previous evaluation surplus on the same asset, you are going to treat it the same way I taught you how to treat revaluation deficit in IAS 16. In such a case, instead of debiting the entire impairment loss to P&L, but because there is a previous evaluation surplus on the same asset, you're going to eat that evaluation surplus first in OCI. You are going to eat the revaluation surplus first in OCI. So you debit revaluation surplus to OCI. So it will be a minus in OCI. Then whatever you have as excess, if any, then that one can go to P&L, then you credit asset. Then I mentioned that we have something called cash generating units. And these usually arise where you have assets that individually they do not generate money. Individually, you cannot determine the recoverable amount. If you cannot determine the recoverable amount, it then means that it will be difficult for us to determine their impairment loss, whether they are impaired or not. So for that reason, we usually get groups of assets together that generate cash inflows together, right? Group of assets that generate cash inflows together. Then from there, we will be able to then get our recoverable amount. So when you have group of assets that generates cash flows independent of other assets, that's a cash generating unit. And its sole purpose in life, that cash generating unit, is just to help us determine recoverable amount. As soon as we have gotten our recoverable amount, that's the end of its purpose. We don't need it again. Because ultimately, when you get recoverable amount, you can easily then get the impairment loss of the entire CGU, the cash generating unit. Then you would be able to then share or allocate that impairment loss to each individual asset in the cash generating unit. And when you are doing that, I told you that you are going to allocate first to a physically damaged asset within the cash generating unit. Then you allocate to goodwill. Then you allocate to other assets. on a pro rata basis. And I made a very important point to you last week, which I also pointed out in the past questions that we solved. I told you that with cash generating unit, if the examiner has already told us that one of these assets is valued at, let's say, net selling price. When they say that, that means that they have already given us the recoverable amount of that particular asset. That then means that you don't have to allocate any further impairment loss to it, right? We solved the scenario like that last week, just to ensure you understand that. Now, after explaining all of that, I then told you that it's possible for impairment loss to reverse, meaning you had an impairment loss before, then in subsequent years, you now had a surplus. That means there is a reversal of impairment loss, right? So that kind of reversal, you just automatically takes it to P&L first. I mean, to cancel out the loss, then whatever is remaining goes to OCI, right? If there is any excess. But I told you fundamentally that when there is a reversal of impairment, the new value of that asset, the new value of that asset must not be higher than the original value of that asset before impairment. It must not. So we don't expect, when you have a reversal, the reversal, which is a surplus, there won't be any excess that will go to OCI because the entire value is going to hit only P&L. Because the reversal will not result in a new value that is higher than the original value before impairment. It will be restricted to the original value before impairment, right? So all of these and more we discussed last week, and I told you that when goodwill is impaired, it cannot be reversed. As soon as your goodwill is gone, it's gone forever. It cannot be recovered. It's gone. Forget about it. Okay, so that was what we revised um, last week. So you as a student, you see, what I have literally done to you now is I have taught you how to be sure that you have read something and you know it. So when you read something and know it, I was able to summarize this standard by heart. I mean, I've opened IFRS 15. It's not like I'm looking at anything, but I was able to summarize it systematically the way it is in the notes. Probably because I teach it. So fine. But I thought you should have also read over again in such a way that you can sit down and within 10 minutes, you should be able to scribble down what you have read. My dear students, if you can do that, that means you know it. That means at least you're sure that at least this one, you know it. You can sit down and write it down. And the beauty of that is that it won't even take you 10 to 15 minutes to write down. Then you go back to your note and check anything that you omitted. You write it again. I mean, that means you can sit down and write or summarize 5 standards in a day. If you have actually, because in reporting, if you go and check your past questions on financial reporting, is not, in fact, it's 70%, let me say 65% theory, and the remaining 35% might be calculation. Is extremely theoretical. Extremely theoretical. Okay, now, what we have today is going to take us like around 1 hour, 15 minutes or thereabout, if you get it very fast, or maybe 1.5 hours at most. So I would advise you to tag along as much as you can and remain muted, because I noticed while reviewing some of your lectures with some other of your lecturers, I saw that some of you will come to class and you will be unmuted. There will be a lot of disruptions in the class, but I've not really experienced such in my class before. I'm surprised people that do that in some other classes. I believe we're not supposed to be monitoring you guys being adults, but I think we'll start doing that now. So, of course, in line with our practice, you can ask questions at any point within the class as you wish. You can raise up your hand, I will identify and answer your questions. So in the meantime, let's just listen and let's follow along. So in front of us, we have IFRS 15, which is revenue from contract with customers. So, I mean, we want to talk about revenue, basically, revenue. So the title of this standard, which is revenue from contract with customers, because we believe that you cannot even earn revenue if there is no contract with customer. You can only earn revenue from a customer. So that's why we have the the title of this standard this way. Before now, we used to have IAS 18, and the title of IAS 18 was just revenue, right? So when they brought in IFRS 15 around May 2014, they changed it to revenue from contracts with customers. You would all agree with me that revenue is the first item in the statement of profit or loss. And usually it's mostly the biggest item in that statement. It's mostly the biggest, is the largest amount you find there. And a successful company would be a company that has huge size in revenue. They use it to measure the growth or the size of a company. So it's a very important item in the statement of profit or loss. And this new standard is coming with a lot of potentials in the sense that we have found out that the old standard we had enabled company um, um, to to manipulate their revenue through false invoicing and fictitious item recognized as revenue and lack of proper guidance as far as revenue is concerned. So all of that is eliminated with this standard. This standard is fully loaded. You know it, and it covers everything you need to know around revenue recognition. So we'll be looking at quite a number of things, from the objective of the standard to the recognition and measurement of revenue. I'll talk about contract costs and some other terms you need to know. And finally, presentation and disclosure. So that's what we want to look at. Now, listen up. Objective and scope of IFRS 15. In the past, I kind of asked this for 2 marks. And the way they asked is that you should discuss or state, not even discuss, state the core principles of revenue of IFRS 15. What we are talking about is the objective of this standard. And the objective of this IFRS is to ensure that the revenue you recognize in your P&L depicts or show the consideration expected by the entity from the transfer of promised goods or services to the customer. Let me stop there. Again, the objective of this standard is to ensure that the revenue you recognize in P&L, the revenue that you put in your P&L, must depict or show the consideration you are expecting. Or if I want to put it simply, the money you are expecting. But the thing is that you transfer goods or services to customer, there could be non-cash consideration, not necessarily money. But I just need you to understand something, that what the standard wants to teach us is just what you would put in your revenue must be what you are expecting to collect. I mean, however you want to understand it, but what you are expecting from the customer, from the goods you have transferred, is clear. That is the objective. The consideration expected by the entity from the transfer of promised goods or services to customers. I mean, this sentence alone carries weight in the sense that it's saying that don't recognize revenue if you have not transferred goods or services. You understand that, much better as we move on today. But let it sink very well now that the objective is that the money you recognize in your P&L must depict, or the amount you recognize in your P&L must depict what you're expecting from the transfer of promised goods or services. It's what you're expecting. If you have not transferred goods or services, you are not expecting anything. Or you have only transferred just half of the goods, that means you can only recognize just half as revenue. So the revenue recognized in P&L must depict consideration expected by the entity from the transfer of promised goods or services to customers. If you can tell them this in the exam, that's 2 marks. You don't have to cram this. Just remember that what you put in your books as P&L must be what you're expecting, the money you're expecting from the goods you have transferred to customer. If you understand that, you don't have to cram this word for word. But of course, there's nothing wrong in knowing the consideration expected by the entity from the transfer of promised goods or services to customers. Okay. Now, when you recognize that, then you need to ensure that the information we provide to users, right? When you recognize only the amount you're expecting as revenue from the goods you have transferred to customers, then whatever information you are giving in the financial statement will enable user to understand the nature, the amount, the timing, and the uncertainty of your revenue and cash flow arising from contract with customers. You'll be able to understand the nature, what type of transactions have you consummated, how much are you expecting, when are you expecting it, and of course, we'll be able to see some that you might not get, because in your disclosures, we will have seen the total package of what you want to deliver, and we can see what you are recognizing, and you will have explained some other disclosures. So we would enable the user understand the nature, amount, the timing, and the uncertainty of revenue and cash flows arising from contract with customers. Okay, so I've settled a potential 2 marks. So let's move to a potential 6 mark in the exam. Recognition and measurement of revenue. In 2023 or 2022 May, I know it's a May diet, right? I can ask that state the 5-step model for recognizing and measuring revenue. State, they didn't ask you to explain, just state the 5-step model. So in recognition and measurement revenue, there are 5-step model. 5-step model. You just state it. It gives you 5 marks or 6 marks in the exam. And we'll look at that very carefully now. So I need you to pay maximum attention to this, because that's what concerns you. After this, we'll just look at some other few areas, then we'll be done for today. So step 1, which is identify the contract with customer. Very important step. Very, very important step. Because this is what kickstarts recognition of revenue. All of you seated here are potential accountants. Some of you are practicing accountants, right? So in whatever capacity you have, before you can even think about recognition of revenue, the first thing we need to identify is there a contract with the customer? And when we say a contract, it's usually an agreement between 2 parties that creates enforceable rights and obligation. It's an agreement between 2 parties that creates an enforceable right and obligation. It could be oral, it could be written. But maybe there are any customary way in which they execute a contract. Don't see a contract as something that must be written. There could become some practices they use to agree. They must agree first. And when we say contract with a customer, okay, it can only be within the scope of IFRS 15 only when these 6 criteria are present. So a contract is a contract as far as IFRS 15. So all this must be present, not necessarily, at least these items must be present when before we can say, okay, this qualifies as a contract. Number one is that the parties must have approved the contract, whether in writing, whether orally, whether in accordance with any customary business practices. They should shall approve it. Have they agreed? That's what's important. Whether orally, written, whatever practice they used to, whether it is by laughing at each other, whatever. Have they agreed? If the answer is yes, okay, then good. And of course, they are committed to carrying it out. So that's one. Two, each party's right regarding the goods and services to be transferred can be identified. So each party knows what he is doing. The person that is supposed to pay money knows how much he will pay. The person that is supposed to transfer goods knows how much he will knows what he is transferring. Everybody's right regarding the goods or services to be transferred can be identified. It's clear. Three, the payment terms. Are we paying for the goods or services is identified. This is a very important point. Because why are we even consummating transaction? Is to get value. So the payment terms for the goods or services can be identified, and the contract must have a commercial substance. There must be commerce. It's not a contract to sell, because I mean, my child can come to my office and say he wants to buy goods for my company and we sell. It might not qualify as a contract, because if there's no commercial substance, it's not a contract. There must be commercial substance. And when we say commercial substance, it means the risk, the timing, the amount of the entity's future cash flow is expected to change because of the contract. Money must change hands. There must be risk involved. We must be doing business, not joking around. So the contract must have commercial substance. Money must change hands. The risk, the timing, the amount of the entity's future cash flows is expected to change. And also, it's probable that the entity will collect the consideration to which it will be entitled. He will collect his money. It must be probable. We must be sure that the money will be collected. The consideration that is entitled to, he will collect it. Thus, the contract can be written, oral, or implied. So, usually they can ask you this either 5 or 6. Mostly they ask it at CR level, professional level. Usually for you, I don't know why they don't like to ask you that you should state the criteria for a contract in line with IFRS 15. They can ask you this diet, so cram it. And it's very logical, because whatever you cram, there's a possibility of forgetfulness. It's possible. There's nothing you can do. But there are certain things that you can easily remember. I mean, for a contract now, it's clear that it has to be approved. It must be approved. Otherwise, it's not a contract. The parties to the contract must know what they are supposed to do. Each person must know their rights in the contract. There must be payment terms, commercial substance. The money will be collected, whether the contract is written, oral, or implied. Remember 4 or 5, then you walk home with 5 marks in the exam. So let's see. Now, so this must be present first. You see, when a contract with a customer does not meet the criteria above, you cannot recognize revenue. Even if the customer has paid you, even if you have collected money from the customer, you cannot recognize revenue. This must be met. So if you now collect money and the contract in question does not meet the above criteria, that means you as accountant, because money has been collected by your company, you debit bank. Now, we say you cannot credit revenue. Then what do we credit? You credit liability. We call it a contract liability. That is what you credit. It's a liability because for us, we believe that the customer can still come back and say he wants to collect back his money. Because if these are not present, that means you guys are not serious about this entire thing. Then we believe these are primary things. What each party is supposed to do, the money, how much, when we are collecting our money and all of that, it must have been agreed. If we don't agree that means the customer is not serious yet. He can come back and say, my money, that what the goods you deliver is not what he wanted. That I don't want that goods. Please give me back my money. Since you did not agree it, he can come back and change everything for you. And he will collect. So don't recognize revenue because we don't joke with revenue in our account. Remember the objective. What you recognize as revenue must be the consideration expected from the transfer of promised goods or services. So don't just recognize anything there. So rather, when you collect money and this criteria is not met, you recognize a contract liability. Okay? So as soon as you meet the criteria, then of course you can cancel out this account, then recognize revenue. Or if you are lucky that you people have said that the money is non-refundable, that means you have jail on here. The money is not refundable. So it is either when you have no remaining obligation to transfer the goods, then that's fine. Recognize revenue. You have no remaining obligation to transfer any goods. Or maybe the contract has been terminated and consideration received is non-refundable. Then fine. Then you can recognize revenue in that case. Okay. Now, two more things. I want to quickly look at two things. Number one is contract modification. Number two is contract combination. Those are the two things I want to look at. I can ask it in your exam. So no cramming, understand it. So combination, of course, meaning that combining two or more contracts that you entered at the same time or almost the same time with the same customer. Okay. So we are saying that instead of treating those type of contracts separately, why don't you see it as a single contract? So we are saying that when an entity enters into two or more contracts at the same time with the same customer, that it can account for them as a single contract if one of these criteria are met. I kind of asked this before for 3 marks. They said the criteria for combination of a contract. So number one is where the contract are negotiated as a package with a single commercial objective. If all the contracts are negotiated as a package, so even though you people executed different contracts, but all of it together, when you put it, they are all achieving a single commercial objective. It's just like you want to help somebody to build a, let's say an app. I'm just saying. So you now negotiated for for the you negotiated for the design of the app. You negotiated as a separate contract. You negotiated for the main development as a separate contract. Then you now negotiated the go-to market, or let's say the installation as a separate contract, like that. But all of them has a single objective of, okay, an app. Or probably you enter into a contract with somebody to build to build a house. So you now negotiated different components of that. So you get the idea of what I'm talking about. So when you have contracts that are negotiated as a package with a single commercial objective, just combine them and make life easy for everybody. So see them as a single contract, or where the consideration to be paid in one contract depend on the price or performance of the other. So that means before you can even move to the next contract, you must have finished one. So that means just combine them and see them as single one, because you need to do one before you can move to the other. Or where the promised goods or services in the contract is delivered as a single package. Is it like you are delivering a product like take, and you people have now negotiated different contracts for this, for that, and all of that. But ultimately, you are delivering a single package. You are delivering a single product. Combine all those contracts together. So you combine contracts together when any of these three criteria are present, one or more of them, whether contracts are negotiated as a single package with a single commercial objective, where the price of one contract is dependent on the performance of the other contract, or where the goods or services promised in the contract can be delivered as a single package, then combine them. Also, is contract modification. When we say modification, is of course would mean where there are changes, where there are adjustments. So in the context of a contract modification occurs where there is a change in the scope or price of a contract that was approved by the parties. So those changes in scope or changes in price were approved by the parties to the contract. So that's a contract modification where there is a change in scope. You know what that means? Scope. You say you want to deliver A. Then I say, okay, well, now you have to deliver A, B. Changes in scope. Or probably the goods you're supposed to deliver, it was 2 naira before, now it says 3 naira. Changes in price. So that's a contract modification. It happens always, right? In fact, now in Nigeria now, it's even a common phenomenon where the prices of commodities and assets are relatively unstable. So you find out that a lot of contracts will be modified. So when there is a change in the scope or price of a contract, that is a contract modification. Now, when we have a contract modification, so are we going to account for that as a separate contract? As a separate contract. Okay, so what I mean by as a separate contract is this. So somebody said that, Adekunle, please supply us 20 bottles of cement, right? So later they now called you again and said, okay, can you make it 30? Can you make it 30? So meaning additional 10, right? So that's change in scope. What we're saying is that that modification, that additional 10, can, is it a separate contract? Or are we treating the entire 30 as still a single contract? Okay, so we are saying that it will be a separate contract if these two conditions are present. Then just treat it as a separate contract. Don't treat that modification as part of the original contract. You're going to treat it as a separate contract if these two are present. Number one, the scope of the contract increases because of the addition of promised goods or services that are distinct. I mean, this is the main point. If you don't put this one there, because of course we know that the increase in scope is because of addition of promised goods or services, right? But it's important that those addition must be distinct. Of course, your mind is already running about what do we mean by distinct. You have to be patient. I will definitely explain that to you. But distinct, it must be distinct. That increase in scope must be as a result of addition of promised goods or services that are distinct. That's one. Number two, the price of the contract increases by an amount of consideration that reflects the entity's standalone selling prices of the additional promised goods or services. I mean, you don't have to cram these things because the price must have changed, of course. But we are saying here is that that change in price must reflect standalone selling prices. That's the key word there. If the increase in price reflects standalone selling price of additional goods or services, then it's a standalone selling price is the price at which an entity would sell a promised goods or services separately to a customer. So that means ordinarily, that's the price they will have sold an additional goods. So if the price now change by an amount at which you will have sold an additional goods, then that's a separate contract. It's a separate requirement. Okay. So we are saying that treat it as a separate contract. If the change in the scope, okay, if the increase in the scope is because of addition of promised goods or services that are distinct, important, that are distinct. Number two, if the price of the contract increases by an amount of consideration that reflects the standalone selling prices of the additional promised goods or services, then I mean, standalone selling price is the price at which the entity will sell a promised goods or services separately to a customer. That's the price they ordinarily sell a separate goods. So if the price change by that kind of amount, then you are going to treat the contract as a separate contract. Let's look at the question to clarify that. It says an entity promises to sell 120 products to a customer for 12,000 naira. That is 100 naira per product. The products are transferred to the customer over a 6 month period. Okay. The entity transfers control of each product at a point in time. After the entity has transferred control of 60 products to the customer, the contract is modified to require the delivery of an additional 30 products, bringing it to a total of 150 identical products to the customer. When the contract is modified, When the contract is modified, the price of the contract modification for the additional 30 product is an additional 2,850, okay, or 95 naira per product. The pricing of the additional product reflects the standalone selling prices of the products at the time of the contract modification, and the additional product are distinct from the original products. Does the contract modification constitute a separate contract? Okay. So, I mean, all the elements are there. So, you sold 120 product to a customer, and of course, for 12,000, that is 100 naira per product. Then, after you have delivered 60 of the products, the customer said he needed an additional 30. Okay. And we priced it at 95 naira per product. So, and the question has even told us that this 95 naira is the standalone selling price of the product. And they have told us that the additional product are distinct. So that means this 30 additional product is a separate contract. From the question alone, they have already told us, they have given us all the clue, all the requirements are already checked. So here's the solution here. Here's the solution here. So the contract modification for additional 30 products is a separate contract because it increases the scope of the contract because of the addition of promised goods or services that are distinct. The only way I know that is because the question told me that the additional products are distinct. So, and again, the price of the contract increases by an amount of consideration that reflects the entity's standalone selling prices of the additional promised goods or services. So the price itself, it increased by an amount of consideration that reflects the standalone selling price. How I know that the increase in selling price is a standalone selling price is because the question told me, that the pricing of the additional product reflects standalone selling price. So the question told me already. So when those two criteria are met, where the changes in scope reflect additions of promised goods or services that are distinct, and changes in price reflect standalone selling prices, then treat that additional requirement from the customer as a separate contract. Okay, so ultimately now, we are going to recognize 100 naira for 120 products, right? Because that's the price we're selling in the original contract. And in the new contract, it will be 95 naira for 30 products. Okay, and that's the solution to this question. That is the solution to this question. However, I did some oversabi here. Okay, I did some oversabi here. What they did not ask us to do. I was just trying to explain a few things, right? I'm just saying that what happens if the additional 30 product does not reflect standalone selling price, like the question actually told us that the price of the additional 30 products is not a standalone selling price. So that shows that we are not going to treat the modification as a separate contract. It will not be a separate contract. So that means we're going to treat it as a termination of the original contract and a creation of a new contract. So that means it's not a contract of 120 products anymore. It's not a contract of 150 products. So that means the original contract has been terminated and is now a creation of a new contract. So consequently, the revenue we now recognized is now first, we would have already recognized the the 60 naira that we have transferred, the 60 products we have transferred already are at 100 naira. Okay. Then the one that we have not transferred, which is the remaining 60. So that will be recognized. And also the additional 30, that will also be recognized. So that means the price per unit now is 98.333. Okay, so this one, yes, it will give you almost same answer as the previous one, but the key thing here is that where the change in price of the additional goods is not a standalone price, then what I need you to remember is that that means the contract will have to be terminated. It's a termination of the original contract and a creation of a new contract. Okay, so that is all for step one. That is all for step one. Any question before we move to step two?
Yes, sir, I have a question, please. Okay, so like you said from the beginning that revenue is recognized when it is earned, when whether you're given the products or you have rendered the service, then you're recognized even if the person have not paid. Am I right?
Okay, yeah.
So now looking at the question we just solved, and the contract was supposed the supply was supposed to be for 6 months. So in this case, and the person has paid, so are you supposed to amortize that kind of payment, or do you recognize it immediately, even though you have not given all the products or you have not rendered the services? Hello.
So your line was breaking. So I think what you were saying is that can you recognize revenue when you have not transferred the goods or services? Is that what you said?
No. I said in this case, when they said 6 months, the contract is for a period of 6 months. So I'm saying that if the money is paid at the beginning of the contract, are you supposed to recognize, even though you have not now rendered the service, are you supposed to recognize that revenue at the beginning, or you space it for the period of that 6 months?
You space it new. So you have to space it. So which is why here now you would only recognize revenue equivalent to the product you have delivered. You only recognize revenue equivalent to the product you have delivered. So that over 6 months, so as you are delivering or transferring the product, it is at that point you'll be recognizing revenue. As you are delivering the product, you'll be recognizing revenue. Okay. So you cannot recognize revenue until you have delivered.
Okay, even though
No.
the money hits your bank once.
If the money hits your bank, see, that was the first thing I mentioned here, that you recognize a contract liability. Instead of you crediting revenue, you will debit bank and credit contract liability. You cannot credit revenue until you have transferred the promised goods or services. I mean, that's the core objective. That's the core principle here in revenue recognition now, which you must never forget. That's the core. You cannot recognize revenue until you have transferred. So it's just like this school, our school now. We cannot recognize revenue for some of you that you are fully paid all your money. Even though you are fully paid, we cannot recognize revenue that, okay, well, this is the amount you have made. Okay, except where
the money is non-refundable. If the money is non-refundable, I'm recognizing revenues. Trade on. The money is non-refundable, or I don't have any other thing to transfer to you again, but for whatever reason, then you can recognize revenue. Okay, so all right, good one, Temitope. Any other question? Okay, let's move to the step 2. Okay, so I've mentioned a lot of things here. So for your exam, you need to know these 5, and you need to know these 2 for contract combination, and you need to know these 2 for contract modification. So now let's go to step 2. Now, okay, Okon, please go ahead. Okay, I thought Okon wanted to ask a question. Okay, yeah.
In this question, we just look at to explain contract modification. So the question spelled out the standalone prices and the other distincts, the
Yes,
products distinction. So my question is, will it always be mentioned like that, or there are other indication that will show that this is what it is talking about? Will it always be mentioned that the price is a standalone pricing and is a product, and the products are distinct in the questions, or there are other indication to show that those two options?
That's a very good question, Okon. That's a very good question. Okay, so no, it will not always be like that, right? So I intentionally structured this question like that because I haven't taught you what I mean by distinct. So I'll be teaching you in a few minutes now. That's step 2. So they will express it. There is no other indicator than to express it. So they believe that you understand what we mean by distinct, which you will know very soon. And again, standalone selling price, they might not give you and call it that the additional price is standalone. They might just expressively give you that that in the past the entity have sold these goods that the entity has sold an additional good for that price before. So you know that standalone selling price means the price at which an entity will sell those goods separately. So instead of calling it standalone selling price, they can just tell you that that's how much they actually sell those additional goods separately. If they want to sell those goods individually or separately, that's how much they ordinarily would sell. So that increase is a standalone price. So it might not be like this in the exam. They could use scenarios to explain it to you through their meanings. Okay, I hope I answered your question.
Yes, sir. Yes, sir.
Okay. Oh yeah, let's all remain muted. Okay. Step 2. Identify the separate performance obligation. Identify the separate performance obligation. So the first thing is this. You see, there has to be a contract first. That's the first thing. And in a contract, one of the things that will be in the contract is the rights of both parties. So the contract will have specified the promise to provide goods or services to the customer. It will be in the contract that I want to provide you certain goods or services. You see, those promises to provide goods or services is what we mean by performance obligation. That's performance obligation. Is the goods or services that is promised in the contract. Now, we are saying that you must identify separate performance obligation. So, because we usually account for each performance obligation separately. And you account for them separately only if those performance obligation or those goods or services is distinct. Now we are back to distinct. So when you're accounting for revenue, right? After there is a contract, the next thing is to identify, okay, what's the goods we are providing? The goods we are providing, we call them performance obligation. So you need to identify whether there are more than one performance obligation or just one. So when we say one performance obligation, we mean distinct. Distinct. And a good or services is distinct if it is sold, it's sold separately. That's the definition of distinct. If it is sold separately, because it has a distinct function and a distinct profit margin. So you sell it ordinarily on its own, because on its own it can perform its function. On its own, it can satisfy the customer, and it has a distinct profit margin. So on its own, the company can know how much he has made. The seller can know how much he has made. So when we say a good or services is distinct, right? It means the customer can use that item on his own. He doesn't need to mix it with, he doesn't need to go and buy something else before he can use it. So it has a distinct function and a distinct profit margin. Then that's the definition of distinct. Okay. So it's distinct if it can be sold separately because it has a distinct function, has a distinct profit margin. So there are two criteria you need to look out for. Okay, I'm actually moving here. There are two criteria for you to know that goods or services that is promised to a customer is distinct, right? And you see, when I say distinct, it means that we can sell it separately because it has a distinct function and a distinct profit margin. But look out for this criteria. Number one, it means that the customer can benefit from the goods or services on his own. That is what I mean by distinct function. It means the customer can benefit from it on its own or together with other resources that are readily available to the customer. Okay, it's just like if you are somebody that sells, let's say, milk to customer, right? Milk, like let's say pig milk. So the customer can benefit from that pig milk on his own. So anybody that now wants to mix it with bread, okay, that one is readily available to the customer. Or whoever wants to mix it with cocoa, or you want to mix it with Maltina. What is important is you can actually benefit from that item on its own. Okay, that's one. Number two is that the entities promise to transfer the goods or service to the customer is separately identifiable from other promise in the contract. So the key word here is that this thing that goods or services must be separately identifiable. That's what we mean by it. You can determine a distinct profit margin I mean, on its own, you can know how much you have made. Like the profit you have made on that product on its own, because you know how much you sold it, you know how much you bought it, you can know what's my profit margin on this product. So that goods or services is separately identifiable from other goods or services in the contract. So two criteria which you can actually say distinct function and distinct profit margin, but expressively is what I've explained here, which is that the entity the customer first can benefit from the goods or services on his own or together with any goods or services that are readily available to the customer. And even you, the company, you can separately identify the goods or services from other goods or services in the contract. In the contract. Okay. Additionally, when we say separately identifiable, I've told you it means that you can determine the profit, but a further explanation of this separately identifiable means that that goods or services is not integrated with other goods or services, which means it is not an input to another good or services to get a combined output. It's not an input. It's not a raw material to another goods or services. That's one. Number two is that it doesn't modify. It doesn't significantly modify or customize another goods or services. And number three is not highly dependent or interrelated with other goods or services. It is on its own. It's separately identifiable. It's not integrated. It's not an input to another, which means it's not integrated with other goods or services. It doesn't significantly customize or modify other goods or services, and it's not dependent or highly interrelated with other goods or services. It's on its own. It's separately identifiable. So distinct. You see, all of these, the entire of these step 2 is just trying to explain to you first that, okay, you must know, okay, what's the goods or services you are providing? Identify that first, because what we account for is distinct goods or services. So if there are more than one distinct goods or services in a contract, fine. So that means we will account for each distinct goods or services separately. So we must be able to know, okay, goods or services A, this is how much you made. Goods or services B, this is how much you made. Goods or services, you will account for them separately. Okay, distinct. And when we say distinct, a good of services is distinct if it has a distinct function and a distinct profit margin. A distinct function in the sense that the customer can enjoy benefit from the goods or services on his own or together with other goods or services that are readily available to the customer. And distinct profit margin in the sense that the entity can separately identify that goods or services from other goods or services in a contract. And separately identifiability means that it is not integrated with other goods or services. It does not modify or customize other goods or services, and it is not highly dependent or interrelated with other goods or services. Then that means it is distinct. Then in that case, we will account for them that's separately. The question. Wiki Limited, a contractor, enters a contract to build a hospital for a customer. Wiki Limited is responsible for the overall management of the project and identifies various goods and services to be provided, including engineering, site clearance, foundation procurement, construction of the structure, piping and wiring, installation of equipment, and finishing. Wiki Limited and its competitors regularly sells many of these goods and services separately to other customers. Explain whether the promised goods or services can be treated as a separate performance obligation. Okay, so Ricky Limited enters in a contract to build the hospital for a customer. Ricky Limited is responsible for the overall management of the project and identify various goods or services to be provided. Okay, so these are the performance obligation: engineering, site clearance, foundation, procurement, construction and infrastructure, piping and wiring, installation of equipment and finishing. So the question is asking that each of these are they separate performance obligation? Okay, in this case, they are not. They are not, because the contractor enters into a contract to build the hospital. So, and unfortunately, you cannot do foundation without site clearance or even your engineering. You cannot do construction without procurement. You cannot do piping without construction of the structure. So unfortunately, each of these are not distinct because they are interrelated. They are dependent on one another. They are not separately identifiable. And the customer cannot enjoy benefit from foundation alone or from procurement alone. So each of these items, they don't have distinct function and distinct profit margin. So as far as we are concerned, so they are not, the customer cannot benefit from each of them separately, and they are not separately identifiable. For that reason, you are going to treat all of them as a single performance obligation. All of them together. It's just one performance obligation. They are not separate at all. Far from separate. Let's look at another question. Don't forget, you can raise up your hand to ask questions if you have any areas of confusion. So another question. It says Kako Limited, a startup tech company, develops an app for use by businesses. It enters into a contract with customer to supply the following: license to use the app, installation service. This may require an upgrade to the computer operating system. We have technical support for 4 years. We have 3 years of updates. And we're told that the installation can be performed by Kako Limited competitors, and it does not modify the app. The app can remain functionally without updates and technical support. Explain whether the promised goods or services can be treated as a separate performance obligation. Okay, so Kako wants to develop an app for a business. So the contract comprises the following performance obligation or goods or services: license to use the app, installation, we have technical support, we have 3-year updates. So they have told us that Kako doesn't have to be the one to do the installation. So that means if he gives them the license to use the app, if he gives the customer the license to use the app, the customer is good to go, because another competitor can actually do the installation. And also, the installation does not modify the app. Okay. And also, the app can even be functional without technical support and updates. And update also. I mean, this paragraph already told us that this license can stand on its own. This license has a distinct function. They said the app can remain functional without updates. And they said the installation itself doesn't modify the app. Okay? Another person can just come and modify the app. So, a license to use the app, Kako can just do that and walk away. He can decide to do only that, because the customer can get that and get another competitor to come and do the installation. So the license is a separate performance obligation because it has a distinct function and a distinct profit margin. Kako can deliver only the license and walk away
based on this information given, because a competitor can do the installation and the installation does not modify the app. The technical support also, the app can remain functional without technical support or updates. So technical support, update, installation, license are separate performance obligation because the customer can benefit from each of them separately and they are separately identifiable. They don't integrate into each one another. They don't modify one another. They are not highly interrelated or interdependent on one another because the app can function without technical support and updates. The solution is here for you to also revise. So that's that. And that's the end of step 2, identifying separate performance obligation. So the entire of step 2 is just for you to be able to know, okay, which of our goods or services that we are rendering is distinct. I mean, step 2 is only relevant when you are rendering more than one service. Okay, if you are just rendering like a distinct goods or service, then fine. I mean, the main thing there is distinct. That's everything around step 2. Distinct promised goods or services. Because we account for each distinct goods or services. Okay. Any question? Or we move to step 3. Okay, let's move to step 3. So the step 3 is to determine the transaction price. Okay, so the transaction price is the amount of consideration a company expects to be entitled to from the customer in exchange for transferring goods or services, excluding the amount collected on behalf of customer. Okay, see that money you're expecting when you transfer that goods or services, that's what we call transaction price. That money you're expecting, that's transaction price. But ensure that you don't include VAT or any money you collect on behalf of third party as part of your revenue. That one is wrong. VAT is excluded. So it's only your own money. Okay, any money you collect on behalf of third parties is not revenue. Okay, so transaction price is the amount of consideration a company expects to be entitled to from the customer in exchange for transferring goods or services. Okay, so this money, that's all really for transaction price. Just that the fact that a lot of things happens to transaction price, like there could be variable elements there because of discounts majorly. Discount. And also, there could be some time value of money depending on when or the timing the customer is paying. If you allow somebody to pay for more than 1 year, or we give a significant credit period that we will not give normally, depending on how the question is structured, you might have to recognize some kind of interest income, because we will treat that as that you need to account for time value of money. You need to recognize that probably maybe you are even giving the guy loan or something. So there might be some interest element that you need to recognize as part of your income. Interest received, depending on how the question is structured. So there could be time value of money and there could be non-cash consideration. And in some instances, you could promise the customer some bonanza or coupon or a voucher, like some consideration that are payable to the customer. That has to be removed from revenue. If you have promised the customer that, why not give it generator, like all of these adverts that you see, that you can win so much, you win house, you will win this. You must calculate that and remove it from your revenue. You will not put it. So all of those has usually affects our transaction price eventually. So if let's look at a common scenario in the exam for determining transaction price. Look at this guy now, Mayfair. He supply computer. What he does, he sells computer. So in 2017, he entered a contract with a customer. And the customer would normally buy laptop from him at 500 naira per unit. So the contract he entered with the customer now stated that if the customer should buy more than 500 laptop in a year, that instead of selling at 500 naira per unit to the customer, he will sell at 450. Remember, if the customer should buy more than 500, you will reduce the price by 50 naira. I mean, for per unit, for everything, it will be reduced retrospectively. So everything the customer has bought from inception to date, the customer will pay 450 naira. If the customer should do more than 500 laptops in a year. So they now said as at 31st March 2017, customer had bought 70 laptops. And this guy therefore estimated that the customer purchases will not exceed 500 laptops. That the customer's purchases will not exceed 500 laptops. And the customer would therefore not be entitled to that volume discount. That's scenario A. Scenario B, they said during the second quarter ended 30th June 2017, the customer expanded rapidly as a result of a substantial acquisition and purchased additional 250 from Mayfair. So Mayfair then estimated that the customer purchases would exceed the threshold. They now said calculate the revenue that will be recognized in the first quarter and the second quarter. So it's clear. I mean, in the first quarter, you will recognize 70 times 500 naira per one. That's how much you recognize in the first quarter. Because the customer is not getting the volume discount. But in the second quarter, now that the customer just came and bought 250. So 250, but they now said he now estimated that this guy will exceed the 500 limits. So since they have told us that means the 250, you will buy it. What we're recognizing for the second quarter, sorry, is 250 times 450 naira. That's one. Number two is that the 70 naira that we have recognized at 500 naira before, we need to recognize that reduction now on that 70 naira because they said the reduction is retrospective. So we need to remove 70 naira times 50 naira. Look at it. In the first quarter, 70 naira times 500, straightforward. In the second quarter, so it will now be 250 times 450, which is because it's buying additional 250. Now at a reduced price, because now we are estimating that this guy will meet up. So from these amounts, we need to deduct the excess he has paid in the first quarter because we valued that one of first quarter at 500 naira. But now that we know that this guy would meet up and he will now buy everything for 450. So that excess amount that we recognized, because we recognize 70 naira at 500 naira in first quarter, we need to remove 50 naira on each laptop since this guy is going to meet up with the volume discount. So we need to remove 35 from 1,112,000. So we're recognizing only 109,000 as revenue. So when it comes to transaction price, we have to be realistic on, okay, how much are we actually collecting
So that is all this guy has done. How much is he collecting from as consideration from the customer? Since he has promised that if the guy should meet up with 500 units, he will buy everything for 450. So in the second quarter that we know he will meet up, remove that excess, that discount. Okay, so that's step 3. Any questions before we go to step 4? Just tag along. I'll be running up soon. Just struggle. Now, when you have now determined the price, that, okay, this is how much we are collecting, which is the transaction price. Then the next thing is now to allocate that price to the performance obligation. You see, this step 4 is only relevant where a contract contains more than one distinct. Don't forget the step 2 that talks about distinct performance obligation. Because when we have more than one distinct performance obligation, usually there will be a single price for everything. So we need to find a way to allocate transaction price to each of the distinct performance obligation. But usually in real life, each of those distinct performance obligation, each of them will have how much we are expecting to collect from each of them. Okay, if they have priced them that way, then fine. That one, this step 4 is not necessary. If they have already priced it in a way that we know how much we are getting, and of course, it should reflect standalone selling price. But if they just say, okay, for all of these contracts, this is the amount, then this step 4 will apply because we'll have to allocate that transaction price to each of the performance obligation in the proportion of their standalone selling prices. Okay, so you need to identify, okay, how much would we sell each of these things? Because it is on that basis you are going to share the transaction price among all the distinct performance obligation. That's how you're sharing it. Okay, so that's the whole idea of step 4. Now, let's look at something practical. They said a network service company gives customers free handsets when they sign a 2-year contract for provision of network services. So they give them free handsets when they sign a 2-year contract. The handset has a standalone selling price of 200 naira, and the contract is for 40 naira per month. How should revenue be recognized? Okay, so you will see that from this question, even though as far as the company is concerned, this company, they think that they are only selling network service for 40 naira per month. But for us accountants, this handset itself is a distinct performance obligation because it has a distinct function and a distinct profit margin. So there are two distinct performance obligation here, the handset and the network service. So whatever money we are collecting, which is 400 naira per month, we need to allocate it between the handset and the network service. And this is how we do it. So the first thing is this. I'm going to allocate this 440 naira per month based on the standalone selling price of the handsets and the contract. So the standalone selling price of the handset is 200 naira as given in the question. Then the network contract for 2 years, that's 40 naira per month, times 24 months is 960. So a total of 1960. So 200 naira of 1160 is 17%. 960 all upon 1160 is 83%. So this is the proportion with which I would allocate transaction price.
So how much is the transaction price itself? The actual amount we are making, that this company is making, is 40 naira per month, and there are 24 months here. So the total receipt is 960. So all I've just done here is just saying that I'm going to share this 960 based on their standalone selling prices, and I was able to get a ratio of 17% to 83%. So now, since this contract is for 2 years, so in year one, the handset, out of this 960, which is the entire receipt for the entire 2 years, I'm going to recognize 17%. 17% of the entire, which is what I've done here. I will recognize it attributed to the handset. So as soon as I'm giving the handset to the customer, I've performed, the performance obligation is done. I've done what I'm supposed to do. I will recognize 162 naira. But because the contract is for 2 years, okay, so I cannot recognize the entire amount this year. So which is why the 83%, which is the portion relating to the network service, I divided it by 2 because the contract is for 2 years. So I'm recognizing half in year one, which is 960 multiplied by 3% divided by 2. Half in year one, the remaining in year two. Okay, and which is what that's how you allocate transaction price based on their standalone selling prices. I allocated transaction price based on their standalone selling prices. So that's majorly that. So I'll still send you some other questions for you to use to practice this. All of them are similar to this. You first of all get a ratio based on their standalone selling prices. Then you now identify, okay, how much are we making in the contract? In this case, it's 960. Then is this 960 I'm going to now share between the distinct performance obligation deal. So the handset got 10% of that amount, recognize it as revenue. Then the contract got 83%, but because the contract is for 2 years, so I recognize half in year one, half in year two. Okay, so guys, we're almost there. Step 5. Recognize revenue when or as the performance obligation is satisfied. Okay, so we have gotten transaction price, we have gotten everything. So as soon as we have transferred the goods or services, recognize revenue. But the thing is that, you see, there are instances where we transfer goods or services over time, and there are instances where it is at a point in time. Okay, so we need to be very careful, because if it's at a point in time, that one is straightforward. Because as soon as we transfer the goods and at a point in time, that means you recognize revenue immediately. But if it is over time, that means you'll be recognizing revenue stage by stage. So let me paint more light on that. So see, when we say a performance obligation is satisfied over time, it usually would be a situation whereby the customer is consuming the goods as you are performing. Okay, so as you are providing the service, the customer is simultaneously enjoying benefit from it. So it's actually a gradual thing. Okay, or maybe you are creating or enhancing an asset for the customer. So as you are creating it, so the entity performance creates or enhance an asset that the customer controls as the asset is created. So as you are working on the project, the customer is using it. So it's over time. It's not something you just provided once. You are providing it maybe monthly. And as you are providing it, the customer is enjoying benefit from it. It's just like these are our lectures. We are teaching you every week like that. So as I'm performing, you are enjoying benefit from it. As I'm performing, you are enjoying benefit from it. And it doesn't have any alternative use. Is just for this use alone, this service I'm providing. So after you have used it for this, for your exams, that is it. So that's performance obligation satisfied over time. So if performance obligation is satisfied over time, so the way we recognize revenue is that, we should be able to measure the outcome of the performance. We should be able to know when I'm supposed to complete the performance. So me as a company now, as equity, we are already entering the third month. So I should have recognized 2/4 times whatever amount you have paid, knowing fully well that the duration of the class is 4 months. So that means I can measure the outcome. Then I would be systematically be recognizing my revenue based on completion, like that, gradually. But it's also possible in some instances that where we cannot measure the outcome. Okay, if that happens, then if you cannot identify the stages, then they say that you recognize revenue based on the cost you have incurred to date. So that is, if the entity expects to recover the cost incurred, okay, then the revenue recognizes to the extent of the cost incurred. So when performance obligation is satisfied over time, so it's either you recognize and you know how much your revenue is, you know the outcome of, you know how much you're going to make, you know the contract price, then you can easily, is either you would then be prorating or recognizing revenue based on performance satisfied or job completed, like that. But if you cannot measure that, okay, this is what I've done to date, then, but you are sure that you will recover your costs, then just get, okay, how much have I incurred to date? Then you can recognize that as revenue. So that takes me to what we call contract costs. Okay, when we're talking about the cost you are incurred today, so contract cost is either the cost of obtaining a contract, like sales commission. Okay, so when you expect to recover such a cost, when you're sure that you recover it, then you can recognize such a cost as an asset. If you are sure that you're going to recognize it. But if it's a cost of obtaining a contract that, regardless of whether you get a contract or not, you are still going to incur that cost. Whether you get a contract or not, you still incur that cost. Then, like maybe obtaining a form or something, and then that kind of cost, just expense it. Okay, when it comes to the cost of obtaining a contract. So that's a contract cost. Cost of obtaining a contract is either you expense, if it's a cost you incur, whether the contract is obtained or not. So you still incur it. So you expense that one. But if it's the one that is, you will not incur if you are not going to get the contract, that you only incur when with the hope of getting, or when you're sure you will get, then that one, and you're sure you recover your cost, then you can recognize it as an asset, pending when you make your money, right? So another contract cost can also be cost of fulfilling a contract. Okay, cost of fulfilling a contract. So as you are incurring cost on a project, So you can be recognizing it as an asset. Of course, you have to be sure that you will recover your costs, but you have not recovered, you are still spending money. So you can just be recognizing all that as receivable until. So that's contract cost of obtaining, and cost of fulfilling. So this is usually applicable where performance is satisfied over time. That's when you can be talking about contract cost, capitalizing it. And you see, when you capitalize a contract cost, eventually, when you start making money, when they start paying you, you need to start expensing it. You need to start taking it to P&L systematically, the same way as you are getting your money back from the person that gave you the contract. Is systematically how you're going to recognize it as expense too. So you amortize it the same way you are collecting money from your customer. So contract cost, the cost of obtaining a contract, the cost of. So one more thing is we have looked at performance obligation satisfied over time, and there is one satisfied at a point in time. So when we say satisfied at a point in time, it means at the point where the customer obtains control of the promised goods or services. Then that's where that kind of performance obligation is satisfied, when the customer obtains control. And the customer obtains control when now I can ask for my payments, and when I have the right for payments, the right to payment, or the customer now has legal title, or the supplier has transferred physical possession, and the risk or reward attributable to ownership has now been transferred to the customer. Then the customer obtains control. That means I've satisfied the obligation at the point in time. Then I can then recognize revenue. So that is that. That's the entire thing for IFRS 15. So finally, there are a few things I just need you to note. 3 terminologies here. Okay. I think it's 2. You already know standalone selling price and transaction price. So 2 things here is contract assets and receivables. So mostly everyone is familiar with receivables, right? But receivables is when you have transferred goods or services to the customer, and your right to consideration is unconditional. That is only passage of time that is required before your payment is due. That is, you have transferred the goods or services to the customer, that you are just waiting for the credit period to lapse. That maybe the guy is going to pay you at the end of the month. Then those kind of money, those right to consideration, is what we call trade receivables. However, where the entity's right to consideration in exchange for goods or services that has been transferred is conditional on something other than passage of time, like entity's future performance. Okay? That is a contract asset where your payments, where your consideration is still conditional, is still conditioned on some other things other than just passage of time. So like you need to do 1 or 2 things that you are not supposed to, that you have not done. For example, now you have delivered goods or services fine to the customer, but you did not send invoice. That means that's conditional, or some other things you're supposed to do. That is not just passage of time alone. Well, we are not saying you haven't transferred goods or services, whether contract asset or receivables. You have transferred goods or services, you have recognized revenue, you have credited revenue, but you only debit trade receivables where the only thing delaying your money is just time. But where there are some other things you're supposed to do, probably they require you to fill some form or to do some things or some specific or whatever that you have not done. So when your payment or right to consideration is conditioned on some other things other than passage of time, that is a contract asset. You debit contract assets, not receivable. So I need you to actually know the differences between that. And I've already explained contract liability already. So, and there are certain disclosures that must be made. Every standard has a disclosure. So, of course, revenue must be separated from other sources of income. If there is impairment loss on receivables or contract asset, you must separate it from other impairment losses. You must show us your opening receivables and opening current contract assets or contract liabilities. You must tell us the revenue recognized in this year that was included in current as a contract liability at the beginning of the period, right? Meaning that you have collected money last year, but you only recognize as revenue this year. You must do those separation for and some other stuff like that. And I've also listed some past questions. It's not outside what I've taught you. It's just what I've actually explained. There's nothing new here. So all the solutions are here for you. I kind of asked it severally. So that's it. That's it for us here. So that's the end of this class. On another note, guys, we are going to be doing like a survey, which we want you guys to respond to. We are assessing the effectiveness of these our evening classes. So for me, I always try to just finish early. I always want to be very practical because I know even me, I've gone to work, come back. It's not even easy for me to teach at this evening time compared to during the day or in the morning or on weekend. So we're actually thinking we're going to do a survey and see what is best for us so that we can attract more people and more joiners. A lot of you might even be sleeping now, so because you're tired. So we want to move these classes to weekends, not this diet anyways. You guys are still in school, so you are still very much with us. So we're going to do a survey. Please respond to it. So if you want the class to still be weekends, to still be weekdays, like we have it right now. I know we used to have classes. Do you have online classes on Saturday? Yes, we have online classes on Saturday. So we want to eliminate weekend classes entirely. I say weekend, weekdays classes entirely. So if a lot of our current students want weekdays, we just know that, okay, maybe the weekdays is fine with you guys. But if a lot of you guys want weekend classes, that means this night will be the last time we'll be having weekdays classes. So from next night going forward, the virtual classes is going to be just like the physical. While the physical are having their own classes, you guys will also be having your own virtual class during the day, from morning, of course, till evening, on weekends at the comfort of your home instead of weekdays. So please respond to that survey. So do you have any questions?
Yes, I do.
Okay, please ask.
So it's the contract assets. So please, can you scroll up? It's conditional where it's not just the passage of time that is required before the payment is due. So
All right.
when the goods and services are being transferred and there are other expected requirements, is there any risk involved?
Risk to who now?
To yeah, the parties of the contracts, not the customer, the contract itself, the parties to the contract, I mean to say, or the suppliers of goods or services.
So risk in the sense that is it credit risk you're talking about? Because the guy has
Yes.
done work, he will collect his money. is not there is no question on that. But you need to do some things. And if you don't do it, you might not collect your money. So since it's conditional on those things and it's in a contract that you have to do those things, it is until you do it before you collect your money. If you like, take 10 years. It's after 10 years you collect your money.
Okay.
Yeah.
Okay, so I also have another question, sir. Is there any is there like contract modification and contract amendment? Are they the same?
Yeah, but the standard mention modification. So is literally they are the same. They are the same word. Amendment, modification, the same word. But the IFRS 15 chose the modification. That's the word it chose. I mean, what is important for us is what it means. If there is a change in scope or a change in price. So just account for it properly, whether as a separate contract or as a termination of the original contracts and the creation of a new one, depending on whether it meets those conditions I mentioned earlier. So Prudence, any further questions?
No, it's fine.
Okay. Another question.
Techno, sir.
That's not your name. What's your name?
Latif.
Which one is Techno? Samsung name. Yeah, go ahead.
Good evening, sir.
Good evening.
So under that contract modification, when you say change in scope, do you mean that scope stands for size of the contract?
Correct. The goods or services.
Okay, sir.
The goods or services. So if they request for additional goods or services, that's change in scope.
Thank you, sir.
Yeah.
Okay, so the commercial is now the pricing and the quantities.
So again?
I mean, the commercial aspect of the contract that has to do with the prices and quantities, that's different from the scope that has to do with goods and services.
Yes. It's the commercial that we are talking about. The price of the goods and the goods itself. And that's it.
Okay.
That's the price and scope.
Okay.
It's just that's what we are talking about.
Okay, thank you, sir.
Thank you, sir.
Okay. So before we go now, is there anyone here that want us to continue our weekdays classes? That weekdays is just best for you?
I think you said you roll up a survey. There are still other information that will be in the survey that will look at.
Hello? What happened? You were saying something.
Yeah. I think you said you roll out a survey. So there are other informations in that survey that will factor in
Yeah,
before
no
we
other
can do.
information. I just wanted to hear from some people before we roll out the survey.
Let's wait till then, sir.
Okay, let's go and sleep. Have a wonderful night. Bye.
Hello, sir.
Yes, Latif.
But the sincere truth is that I love that initiative that you want to introduce. I think there will be some senses in it, but still we see the survey that you roll out. It's a very good one.
Okay. Oh,
Thank you.
okay. So Tayyip, you want to ask a question? Okay, I'm not sure he want to ask any question. Okay, guys, right, let's go. I thought somebody wanted to ask a question. People are raising their hands, but they're not saying anything.
Maybe they've slept off.
Good night. Bye.
Thank you, sir. Good night, sir.